the market has stalled again. We hit another record high yesterday. We're flirting with the closely watched 5,000 level on the bellwether S&P 500, but not today. Today, the markets take a breather and think, what's next now? Because again, we're looking at a calendar here devoid of really obvious catalysts, and so it's a hodgepodge out there. Welcome. This is Macro Money. I'm Ilya Spivak, head of Global Macro here, and we're going to take this opportunity while the market is digesting to take a look at what has been the driving narrative for the story really over the course of the past 3 months now, the outlook for Fed monetary policy, and consider the absolute flurry of commentary from Fed officials this week shaping the narrative. See where we are on policy expectations, where we might be going next, and what Fed officials think about it. Because it will be through this lens, most likely, that markets are going to evaluate what happens next, because, of course, event risk returns next week in explosive fashion. So what I've done here is put together a kind of digest of what Fed policy officials said over the past 5 days here, starting with a 60 Minutes interview of Fed Chair Powell, and pulled out 5 of the driving narratives that seem to be on display, the key themes that policy officials are trying to communicate to markets. And some of it is encouraging, and some of it should have stocks more worried than they appear. And so it'll be an interesting thing to look through how the markets have tuned their lens to all of this when key event risk has to pass through it again next week. So let's consider what we're looking at here. First and foremost, of course, let's get a sense of place. So here we are north by a hair of the 5,000 figure on the S&P 500. And probably the most telling part of this story is that we are doing this as interest rate cuts are falling out of the outlook, which is pointedly different from what we saw basically through the entire back half of last year. So consider here's middle of last year, and what you see is rate cuts start to diminish as markets get a handle on the idea that the SVB-led banking crisis has been ring-fenced. The issue with the U.S. debt ceiling is manageable. And so you have here a reduction in the number of rate cuts expected for 2024. This is from Fed Funds Futures, and this is the spread between the January and December future for this year. So in other words, it's telling you what the difference is going to be between the implied rate in January and the implied rate in December, which then, of course, tells you how many rate cuts you're expected to see. So we can see that as this was being driven lower, stocks were falling. They didn't like it. They thought higher interest rates would be a barrier to growth, higher financing costs for virtually every version of economic activity, and so they didn't like it. As we got into the end of October, beginning of November, we can see we rounded something of a inflection point here, and rate cuts started to build again, which of course pushed stocks higher in explosive fashion through November and December. There's a very pointed change of pace right here, though, as we enter into this new year. So here's January, we've entered into 2024, and we can see that the run of U.S. economic data, which has increasingly improved relative to forecasts, has diminished how many rate cuts we're looking to see, now to just about one over the course of this year. That's down from 158 basis points, or essentially shaving off 50 basis points or 225 basis point rate cuts out of the outlook. So over here, we were at 6 rate cuts. We are now at 4. The striking thing is that stocks did not do what they did all of last year. They instead are still pushing higher, as if to say, well, good data, good economy. We don't need 6 rate cuts. 4 will do, and risk appetite can hold up. And of course, it is against this backdrop that we look at what these policy officials have been saying this week. And you can see the list of speakers is long. 8 distinct speakers from the Fed, including regional Fed branch presidents from Chicago, Cleveland, Minneapolis, Boston, Philadelphia, and Richmond. Also, member of the Fed's Board of Governors, Adriana Kugler, spoke, and of course, the Fed chair himself, Jay Powell. And there's 5 themes from this that have jumped out. The first is that nobody seems ready to declare victory on inflation. Nobody seems to be in a rush. In fact, one of the things that Powell repeated from the February 1st FOMC press conference is that a cut in March is unlikely. And from there, the theme seems to be policies in a good place, and it would be a mistake to cut too soon, says Mester. Kashkari thinks the Fed has more time to assess the situation. Collins, who's relatively hawkish, thinks that we need more evidence before we can even consider cuts. And Tom Barkin thinks that at this point, we need to be patient and there's no hurry. In other words, the Fed is not in a hurry to cut rates. And if we look at the likelihood here, this is from the CME FedWatch tool that's so helpfully available online. You can see here that the likelihood of a move in March here is, at this point, barely approaching 20%. So you can see right here, this is the current setting of rates, 82% chance almost that we're going to stay here. Now, in May, it's a very different matrix. There is only about a 37% chance that we're going to stay. So by May, the cut is essentially there, or at least it's there with better than even odds. You can see here 53% chance of one cut, and the cumulative probability of a cut is 63% or so, because there's a slight chance that we have a 50 basis point reduction. When you get to June, we're talking about, at this point, next to no chance that there aren't cuts, and now at this point approaching 80% chance that we're going to be somewhere in the 50 to 75 or a 25 to 50 basis point range. And if we look at the cumulative numbers, the cut is almost done. So because there is, you can see here, a slight chance, 8.8%, that we have 3 cuts by then. Certainly, I don't think the expectation is that there is a single 75 basis point cut, but there is an expectation that there is some chance that we'll have that many by then, which serves to reinforce, I think, that we're better than even for May for the start of the easing cycle. Now, that, of course, speaks to the next key theme here, which is that while we're not sure about March, and we're saying that we're not in a hurry, that there will be cuts and that this is the bias, is overwhelmingly on the lips of virtually everybody that spoke this week. Powell said the forecasts haven't changed since December, most likely. And then at that update, the Fed said 3 cuts this year. Austin Goolsbee of the Chicago Fed doesn't even want to rule out March. He's relatively dovish. That's not unexpected. Mester says, and she's relatively hawkish, she still expects 3. Kashkari, 2 to 3. Collins, again, a hawk, thinks that easing is appropriate at some point later this year. So the direction of travel is toward cuts. There's 2 things to note here. The first is that the idea that the Fed is going to cut rates is probably not market moving anymore, because this could not be any more unmistakable. And secondly, that there is perhaps an effort by the Fed here to broaden the range of possible timings for the easing cycle. The scuttlebutt out there has been for several months now that the Fed is not going to want to become embroiled in some sort of a political situation around the election. And so there's probably not a strong chance that there's going to be a cut that's going to occur in its general sort of gravitational pull. And so you probably don't get anything in September. You might not even get something in August. Or July, rather. There is no Fed meeting in August. Instead, you have the Jackson Hole Symposium. But what the Fed is trying to say here, perhaps, is that actually everything is live, because the Fed is going to so thoroughly pre-announce that it intends to cut that there isn't a political conspiracy theory that develops, even if they were to do it, say, in September. And so that's seemingly what can be extracted here. The Fed is angling to cut. The question is just when. And the timeline seems to be later than the markets necessarily would like to see, at least when they were scratching and clawing for a move in March. And of course, as we've just looked at momentarily, the markets agree. They've baked in 100 basis points in easing already. Next, while the economy appears to be resilient at this point, there is still the risk that this will not continue. That essentially the last mile on disinflation is going to have to cause some kind of economic turmoil. And that can take the softer version of the argument. When we look at what Powell says, he says we're not prepared to say that we have a soft landing. Barkin says declaring victory is enticing, but he's not ready to do that. The key things here coming from seemingly Mester and Kashkari, both on the hawkish spectrum in their current iteration, saying most of the disinflation that we've seen so far has been on the supply side, not the demand side. In other words, inflation has fallen because supply disruptions linked to COVID have been mended, not because the economy has become weaker. But, of course, inflation, as we just saw, isn't in a place where the Fed is prepared to declare victory on having conquered it. So there's still more disinflation ahead, but the Fed ostensibly sees economic weakness as the likely cost, or at least the risk, of going that last mile. And indeed, we wanted to look at the catch-all here. Here's U.S. composite PMI numbers for January, and we can see they registered much better than expected. Manufacturing returned to growth. The composite index much stronger than anticipated because of a brisk pickup in services, in addition to that rebound in manufacturing. So the economy seems to be humming along. And of course, we've seen various reflections of this data in better than expected GDP, better than expected NFP numbers, better than expected JOLTS, job openings numbers. So when the PMI signaled that the economy seemed to be doing better than the markets were anticipating in January, it did seem to anticipate a strong run of economic outcomes. So it is certainly the case that the economy appears to be doing well at the moment, at least relative to forecasts. The issue seems to be the bit about most of it has come from supply and not from demand destruction, because indeed we see here that while measures of inflation, be they headline PCE or core, excluding energy and food, the decline there has been much more dramatic than the decline in ECI, the employment cost index. That's that sticky inflation component baked into the labor market because of a lingering 2.8 million deficit of workers relative to demand. And essentially what the Fed is saying here is that you need to work that down to get inflation lower in earnest. That ECI thing is down less than 1% and needs to go down more for the Fed to be confident that it's done its job. And for that to happen, you need more economic pain. And the Fed is ostensibly saying, well, we feel like what's been done so far has come without the economic pain for the most part. Higher rates have not driven the economy off a cliff. It's slowed it, certainly, but not terribly damaged it. And we may have run out of room to keep doing that. The next thing may be economic pain as we squeeze labor demand to get that 2.8 million down further, because, of course, we're not going to get it down further by magically manufacturing more labor out of thin air. Next, the upbeat mood for consumers and financial markets may limit scope for Fed rate cuts. Both Kugler and Barkin saying, well, the economy has been strong, yes, but that might undercut progress on inflation. And Barkin saying the strength in sentiment, read stock market there, and looser financial conditions, read stock market again, that's given us perhaps an environment where rate cuts may not come as quickly or be as plentiful. And indeed, we can see here consumer confidence has been on the rise so far this year. We can see that both the Conference Board's measure in the blue there and the University of Michigan's index in the reddish-orange, they've been going up in January. And of course, the start of the upswell really goes back to July of last year. So you can see here, consumer sentiment is falling in the first half of the year, and you can blame the SVB-led banking crisis. You can blame the shenanigans in Washington, D.C. around the debt ceiling. But since those things came and went, consumer confidence has been improving, and in particular, in January, seems to be especially buoyant. And of course, most of the U.S. economy is consumption. So if that's what's going on, then perhaps there isn't as much room to cut rates because this will keep inflation more elevated than otherwise. And finally, the neutral rate for Fed policy, the one where it is neither promoting growth nor restricting it, may have gone up. And this is really a bedrock argument that I've been making for the better part of 2 years, that essentially we are entering into a new era where markets are deglobalized, and if globalization lowers costs, deglobalization raises them, that we have a demographic situation where the largest cohort in the labor market is retiring, the baby boomers, and there is increasingly a shortage of labor that becomes structural not just in the US, certainly, but elsewhere as well. And that all of this means more expensive labor, more expensive cost of doing business in general. And all of that means longer lasting inflation and higher inflation structurally. So we're not going back to perhaps inflation in the low ones, struggling to get to 2. And because of that, interest rates are likely to be structurally higher going forward. We see this from a number of participants here across the spectrum. Barkin saying it's conceivable that the neutral rate is higher. Collins is calling it R star, which is the economics nerd name for this neutral rate. And of course, I put myself very much in that camp. The comments from Kashkari saying that, yes, maybe it's gone up, so the current rates aren't overly restrictive. In fact, this might be something approaching a new normal for interest rates. Again, seemingly saying, yes, rate cuts are coming, but don't expect us to go back to 0. Don't expect us to go back to 1. This is likely to be something that is a cutting cycle with a much higher floor than what there was before the pandemic, which of course is at the heart of what is the structural risk for markets here. We are looking at an absolutely eye-watering amount of debt out there that has an average maturity, if you throw it all in one bucket, of about 4 to 5 years, which means that most of this debt was incurred at rock bottom interest rates and now has to be refinanced, not all at once, of course, and not all this year, but increasingly at much higher rates, 4 or 5 times the rate. And if the floor is indeed higher now, then even with rate cuts, it'll still be, let's say, 3 times more expensive to refinance some of this stuff incurred right before the pandemic and during it. And so you're looking at a very potent risk to credit markets, to the stability of borrowing costs, if this goes the wrong way. And so with that in mind, we have a situation here that isn't anything the market is concerned about today, but the ticking clock on this clearly is out there, and the Fed clearly is watching with some concern. And of course, this speaks precisely to something that we've been looking at for a while, and that is that after the start of a Fed rate hike cycle, a spike in the VIX, which is some period of market instability, tends to follow about 24 months later. And with the March 2-year anniversary of the Fed tightening cycle right ahead of us, we seem to be right in the danger zone as far as the window for this, if it holds. Of course, it need not. It's not a statistically significant sample of occurrences here, but nevertheless, a concern. And finally, the next step to look at all of this stuff and have this lens tested is the US CPI report next week. Expectations that the headline will hold unchanged at 3.4 and the core will dip from 3.9 to 3.7. If the US data flow trend continues to be toward better than expected numbers, though, this could surprise higher and activate all of the concerns that Fed officials have here, pushing back rate cuts still further. And then, of course, we'll see if stock markets remain resilient. And that is Macro Money for today. Thanks very much for joining. We're here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what happens thereafter. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call Sundays, writing for News and Insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for tuning in. Macro Money will be back next week. Futures Power Hour with myself and Chris Vecchio up tomorrow. In the meantime, happy trading. Take care.